Welcome to the Street's end of the year wrap up. It's been a year like no other with the coronavirus pandemic changing life as we know it. And for markets, what was once a bumpy roller coaster ride has now transitioned into quite the adrenaline rush, with markets now pushing all time highs. I'm Katherine Ross, and joining me to discuss 2020 in a nutshell are Kenny Polcari, managing partner at Case Capital Advisors, Jeff Marks, senior portfolio analyst with Jim Cramer's Action Alerts Plus, and Bob Lang, real money contributor. Now, guys, obviously, no one could have peeked into a crystal ball and foreseen what we have gone through this year. So I want to break down 2020 from an investing standpoint. And Kenny, actually, I want to start with you because before you went and moved down to Florida and got your tan on, you and I frequently chatted on the floor of the NYSE, and you've been an investor for decades. So had you ever seen anything like this year in the markets?
I have to say, honestly, and you said it from the very beginning, I don't think anyone could have foreseen what the country saw, what the world saw, and certainly what we saw in terms of investing, the markets, the roller coaster ride that we've been on. The onset of the COVID vaccine, COVID virus in January and February, and then the destruction that happened in March and April. But then the immediate kind of turnaround once they launched the stimulus and we started doing research on vaccines, and it appeared as if it was if it was peaking and it was getting better around the world, and we saw the markets come roaring back, and we saw technology so outperform in ways that nobody even expected. Once again, putting it up, what are we up 34% this year on top of the 33% we were up last year. And so really it's been an amazing story to tell for 2020. I think a lot of people are ready for it to be over and they want 2021 to start. But one way or the other, it's caught people, off guard. It's caught people not understanding kind of where the markets were, what's driving them. Certainly in the technology space, that benefited so well from the stay-at-home lockdown mode. You saw these names, you saw all the work from home names suddenly just spiral out of control and race their way up. Amazon and online shopping and retailers all ended up doing very well, while certainly leisure stocks and airlines and cruise ships got absolutely decimated and crushed. So it's been a very interesting year for sure, but one that if you played it right and you stuck with the plan and you stay involved with good solid names, you could have weathered the storm.
So, Jeff, Kenny just brings up making a plan and sticking with it. So, from your perspective with the portfolio, what changes have you had to make and what have you been telling investors?
Yeah, so I mean, longer term, we're long term minded. So we're long term oriented. We're not really too focused too much on some short term trades. But the game plan that we've been using really for the better part of this year is just maintaining a barbell approach to the market. And what we mean by barbell is we have about half the portfolio tied to some of those stay at home trends that Kenny just outlined, whether it be e-commerce, digitization. 5G is one that we think is going to be very important next year. And then also we didn't want to lose focus either on the companies that are going to benefit from some of the pent-up demand that we expect to see in the market, in the economy in 2021. Just an acceleration in the industrial economy, and companies that they may have been hurt in the pandemic, but we think they're going to come out stronger. So that would be like a name like Starbucks, who obviously saw a huge sales hit when there were stay-at-home orders going down, but thanks to market share gains and really and even a deeper push into digitization, which I expect they'll lay out this week when they have their biannual investor day. We think they'll come out on the other side even stronger. So that's really how we've been approaching things. We've been balancing the stay-at-home winners with the vaccine names, reopening plays, and that's what we expect to continue into 2021. And with that, just focused on good companies, great management team, strong free cash flow generators.
So now that Jeff's kind of given you an insight into what AAP has done this year, I want to explain what Action Alerts Plus is, and that is Jim Cramer's exclusive members-only club, which you can track all of their investing moves in their portfolio over on actionalertsplus.com. Bob, for realmoney.com, which is our sister site for The Street, I want to ask you, what have your thoughts been on the market this year? I mean, it's been wild, and we've just heard from Kenny and Jeff, so what do you think?
Boy, if you were going to tell me back in January we would drop some 33, 34% in about 4 weeks, I would have said you're crazy. But likewise, if you were going to tell me that we would bounce back in the markets some 35, 40% and be where we're at right now, on Friday we closed just under 3,700 on the S&P 500, I also would have said you were crazy. So you know what? I mean, we're all taking crazy pills, I suspect. But to be honest with you, I, much like Kenny, I've never seen a market like this, and I've been around for a long time. But you know, a market such as this gets dislocated for particular news, particular reasons, and Kenny will probably attest to this, as Jeff as well, is that it provides some amazing opportunities if you just can hold your nose, jump in the water, and repeat what Kenny said, holding some good stocks, some good quality names, and even getting in there and buying some of these. I mean, some names that I was looking at back in March were gaming names such as Penn and MGM. These stocks got to single-digit status, and now they're up probably tenfold or 15-fold that they were back in March, and it's literally just a 7.5, 8-month time frame. But I do think that 2021 has some amazing possibilities and opportunities in front of us. We just have to be looking for them. I do have a couple of names that I'm going to be putting out for TheStreet later on this month for my stock picks of 2021. I'll give you a little bit of a tease. Two of them are we're beaten up quite significantly this year, and they're somewhat China related a little bit, but I think they're going to you're going to be surprised and see some good returns on the names. And this is mostly in leisure and travel.
Ooh, Bob, you know I'm going to be hitting on that sector later on, so I'm going to be excited to talk to you about that specifically. But we've talked about how different this year is and what stood out, and I want to focus in a little bit more on both the good and the bad. And Jeff, I want to start with you. I mean, you work with Jim Cramer and analysts at FEMA with Action Alerts Plus. What have the conversations been like around this year for you guys?
Well, I mean, the conversations have been all across the board. I mean, coming back, I mean, just look at the height of the pandemic. We were really searching for companies that, as I talked about earlier, that were going to come out on the other end of the pandemic and even stronger position. And as what was just talked about before, a lot of these stocks you had to hold your nose and buy because some of them were falling 5, 6, 7% each day for no reason. But you know, some of the work that we were doing before is we were looking at like dividend yields, and we were as the market was selling off in March, late February and March, some of these dividend yields just got so attractive, and if we knew if the free cash flow could back it, then it was an absolute opportunity. So two of the names that we were buying in the early days of the pandemic were AbbVie and Broadcom, just because the sell-off saw their yields go 6, 7%. So it was just really attractive. So that was some of our early conversations. And then as we moved through the summer months, we were really scrutinizing some of these stay-at-home trends, trying to understand, okay, which companies, not only is this really going to be just a pulled forward of activity for them, but what's really going to benefit from changes in consumer habits. And that led to some great investments that we had in Colgate-Palmolive, which has seen an incredible rise in demand from people doing something as simple as washing their hands more often at home, or also Take-Two Interactive, which continues to benefit from people staying at home and playing video games. And as we moved on, that's really when we really started to emphasize the other side of our barbell, and that's going to be the reopening trades and stocks that benefiting from an accelerating economy. And that's where we looked at DuPont, that has great exposure to areas such as auto, housing, construction, PPE as well, which has just been a very, very strong theme throughout the pandemic. And then in the more recent months, we were looking at the vaccine as a catalyst, and that's what got us into Boeing back in October, because we expected the FAA to approve the 737 MAX before the end of the year, and that was such a big catalyst for the stock. And obviously, Pfizer coming out with the vaccine, 95% effective, that really accelerated this reopening trade as well. But we've been following those narratives. We've been following the case counts, trying to understand and figure out consumer habits and where that's going to apply into 2021.
All All right, Kenny, I'm going to have you take the more pessimistic side. What was one bad thing that stood out to you this year that was not the coronavirus?
Well, it wasn't the coronavirus, but it was affected by the virus, right? Energy got absolutely slaughtered this year, as you know. I mean, even today, after its most recent rally, the sector is still down 30, almost 35%. And so, therefore, if you had any money tied up in energy at the beginning of the year, then you're certainly not necessarily very happy. But I think the action of late, kind of energy lifting its head, this talk about how value is going to be a big player next year, and the fact that now we've got the vaccines starting to be distributed. In the UK, they started today. We'll get FDA approval by Friday, if I understood that correctly, which means we'll probably start with the vaccine in a week and a half or so like that. And even though there's not enough to vaccinate everybody, we're moving in the right direction. And there are at least 3 vaccines plus all the therapeutics now, which will certainly paint that brighter picture. But one sector for sure, energy and financials also got, they underperformed. I think they're still off almost 3% year to date, even after their most recent rally. So if you had money in either one of those sectors, a lot of money, then you certainly are not happy with how you ended the year.
Bob, glass half full for me. What was one good thing that stood out to you this year?
Well, one of the good things that stood out to me was the comeback of retail. And many have thought that the King Amazon was going to be the destroyer of all these companies in retail. We talk about, the big names like Nordstrom's and Target, Walmart, Macy's, a whole bunch of other little retail names. But pretty much since the beginning of summer, these stocks have performed extremely well. I mean, let's just isolate on Nordstrom's for a minute. JW Nordstrom's at the beginning of November was about $12. It's ticking in around 30 right now. Who would have expected them to be up 150% in about 5 weeks' time? And that's just one example. There's quite a few other retail names that have done extremely well that are competitors of Amazon. And meanwhile, Amazon has kind of been stuck in the mud for the past few 3-4 months. It hasn't gone anywhere. So maybe the valuation question on Amazon is being raised and money is being rotated into some of these other retail names. So I think that in and of itself has been a pleasant surprise, even before COVID came around in January, February of this year and had a big impact. Last summer, the impact of Amazon on these retail names, and they've just basically taken them all out and shot them in the back of the barn if they weren't coming up to speed with some sort of really strong delivery and online strategy. But the fact of the matter is that these companies are still around. They're kicking. They're doing some sales, and they're catching their own versus the big monster Amazon. It's quite an impressive run that they've had, and I think that's going to continue into 2021.
I want to zoom in now, and no, not that zoom, and focus in on each sector individually, starting with banking, which hasn't really gotten a whole lot of love this year. So, Bob, do you like the banks?
I do like the banks here, and not for any particular reason that most people would think. And most people think that, okay, well, if interest rates are rising, that's going to be a good move for banks, is that their margins are going to increase. But I just think that, like Kenny said, that these stocks have been kind of left by the wayside by investors. I think 2021 is setting up to be a real strong market year. I think the Fed certainly has the markets back right now, and with interest rates maybe rising a little bit, the Fed is looking for some inflation. Even with a little bit of a rise in inflation, say 1.5 to 2% over the next 12 to 16 months, we could see these banks perform extremely well, especially if demand comes back. They've done well with the banking numbers and also with the housing numbers. Mortgage applications have been up and strong all year long. So I think names like the top names that I'm going for are like Bank of America, JP Morgan, Goldman Sachs for an investment bank, and then also in the banking process as well too. I think they've done extremely well with Apple, with that Apple Card. I use my Apple Card all the time. I mean, I don't know if anybody else here has that, but I mean, that's the first credit card that I'm using to pull out to pay for stuff. So that's maybe there's a little anecdotal evidence over there, but that's a card that's MasterCard for with Goldman Sachs and Apple. But I do think that those 2 or 3 banks, and I think even the mid-tier banks are going to do extremely well in 2021. So I'm kind of encouraged. This is a group that I have my eye on.
Kenny, give me your overview on the banks in 2020, and do you agree with Bob about 2021?
Well, so it's very interesting. Like I said, the banks underperformed in 2020. Like I said, as a group, they're down. If you look at them really quickly, they're down almost 2.5%. I guess still after the most recent rally. But I am looking forward to the banks being one of those sectors that's gonna perform better in 2021. Here's my concern, and I brought this up a couple of times in my daily blog, but I'm of the opinion that inflation is going to rear its ugly head. And I'm under the opinion that inflation, it's going to happen quickly. I'm not saying it's going to happen next month or the next quarter, but I think it's going to happen sometime in the second half of 2021. And so this idea that the Fed has promised to keep rates at near zero through 2022, I think people have to really start to think about, because that's going to cause a dislocation once again in the market. Might be great for the banks. And so therefore, I think that I like the banks, and JP Morgan and Bank of America are my two favorite picks. I own them. I like them. I like what they both do. And so I love the fact that Bob picked those two right at the top of the piece. But I'm much more concerned about what the expectation of inflation is going to do. Great for banks, but bad for the rest of the market.
Now, Jeff, the portfolio has made kind of a lot of moves in and out of bank stocks this year. So what's your view going into 2021?
Yeah, so we like the banks heading into 2021 for a lot of the reasons that were just mentioned. Currently, we have a position in Goldman Sachs, and we have one in JP Morgan. And then the one point I would just add also is that we should see a return of share repurchases beginning sometime. I'm hoping second quarter of 2021. And capital returns, share buybacks, were such a huge part of the story for the banks. Really since they were allowed to buy back stock again. When you have a bank, we don't have a position in this one, but Citigroup, they always had a massive share repurchase program. So I think that once the group is allowed to repurchase shares again, and you have those big nice dividends as well, you'll have some of the reserves coming off. I do think that the group can work higher from here. Absolutely.
Focusing in on one of the darlings of the market, and that is definitely tech this year. I mean, it's just been unstoppable. And Kenny, you mentioned that right off the top. But do you think that tech is getting a little too much love from investors at this point?
Well, listen, yes and no. Depends on what part of tech you want to talk about, right? Because look, tech is going to be, everyone needs to have tech in their portfolio. But I think a lot of people get caught up with, they think that tech consists of 5 names, the FANG stocks, right? Because every time you hear it on TV, the FANG stocks are this, the FANG stocks are that. You know what? Tech is so much bigger than the FANG stocks. And so I think where people need to look at, I think some of those stocks, their valuations are certainly stretched, but I think other parts of the technology sector, and I love the Internet of Things, right? I love the parts of the technology sector that are going to talk about remains interconnected the way they do. How I can talk to my refrigerator, and I can talk to my car, and I can talk to my house, and I can talk to you through my phone, through my watch, and through my bracelet, whatever it is. And so the Internet of Things, I think, is going to be a sector that's going to do very well in 2021 and beyond. But I do think that names like Facebook, Amazon, maybe Bob made that point as it's kind of waffling around, may in fact be a little bit stretched. And so I fully suspect if the market reprices in the early part of 2021, which I think it's going to do, then I would expect that money's going to come out of those FANG names because they're so outperformed and move into other parts of the tech industry.
So, Bob, would you avoid the FANG names going into 2021 or any other tech names?
Well, we saw a big surge this quarter from the semiconductor names, and names like Jeff mentioned about Broadcom and Qualcomm's also already had a really big run. AMD, Nvidia, some of these names have just been on an historic run, and I just don't know if they can continue to move higher and higher through without having any risk for the investors. I mean, who wants to be getting into some of these names at these pricey, lofty valuations that they're at right now. I mean, I'm not altogether a fundamentals only guy. I mix it up with technicals and fundamentals. But so you have to be wary of the fact that these stocks have been on such a long trajectory here of price action. And mind you, momentum stocks can go much further than you possibly could imagine. But I think that when these stocks do come back down and the demand for products and chips and so forth starts to falter, or at least pull back a little bit, these stocks are going to be in for a huge drop back. I know that Jeff has talked about Broadcom and some of these names. We did do some trimming on some names in Trifecta. Chris Versace and I, we pulled back on some Qualcomm. We pulled back a little bit in NVIDIA. Have some of that in the portfolio, and we've done fairly well with those names over the past year and a half. But when these stocks are up by 150, 200, 300% in some cases, like NVIDIA, from the low in March, you have to start harvesting some profits and wait for the opportunities to come back.
So Jeff, with that, what kind of names are you watching?
Well, I mean, specifically in tech, I think Bob is absolutely spot on in that when you have some of these huge gains that we've seen over the last couple years since the March bottom and some of these semi plays, that it is absolutely right to take profits. It's just you're being way too greedy. You're not ever booking a gain, because I mean, some of these have doubled just this year alone, and from that specifically, I'm thinking of NVIDIA, but specifically in tech, we still like a lot of the semis, and I know a lot of them have been mentioned so far: Broadcom, AMD, NVIDIA, Marvell. But something that the latter three have in common is that they all have really big M&A deals that are expected to close next year. And I think that if each can receive the sufficient regulatory, if they can get over those regulatory challenges and get the deal done, I think that these deals can absolutely support some of the valuations, some of the more lofty valuations that they have, because like I'll just look at Marvell Tech. They reported last week that this is a good example. They announced that they were going to acquire Infi about a month or so ago, and what this deal does is it just expands the company's exposure into the data center cloud markets, which are some of the fastest growing areas in tech, increases their automotive exposure, and that's going to be the automotive Ethernet is going to be a huge growth opportunity over the next real decade, really, and it's in its earliest innings just right now. They're really starting to put out added chips into these new models starting in 2021 models. So yes, I do think valuations are lofty there, but I think there are specific catalysts that you can look to that can not only support those valuations, but lead to longer games. But I absolutely do agree, though, that profits do need to be taken in some of these names that have had just such great runs over the last couple of years.
Kenny, one sector that you could argue has thrived for Wall Street, but done so more poorly for Main Street is retail. And that's because we're seeing names, as we've talked about, Amazon, we've seen Target, Walmart, and the likes all thrive. But do you think that we're kind of seeing a K-shaped recovery at this point? And what do you make of retail from a Wall Street perspective?
Well, from Wall Street, how could you beat it, right? Because like Bob said, it's come roaring back. I mean, certainly retail got slammed at the beginning part of this process, but now you've seen a lot of these stores in Nordstrom's, whatever, they've all made this big pivot and so much more online shopping, and so therefore you've seen these names rally back. I don't necessarily think that the brick and mortar part of the business is going to be the story. I think the story is going to be how they pivot and become much more techy, much more e-commerce, because I think that's going to be the story. Nordstrom's is still Nordstrom's, right? It's a great store, people like it. But I think that's where they're gonna make the move. Now, that being said, you've seen massive destruction for the small business retail store, whether they've been, in cities around the country that have just gotten shut down, they've gotten wiped out, people haven't gone shopping. So that part of retail might be under some pressure, but certainly those are also not publicly traded companies, right? So we're talking about retail from the publicly traded sense. I think retail will continue to do well, especially if the economy next year comes roaring back the way that everyone thinks it is. I think the latest survey out of the NABE said that 73% of the economists surveyed expect the economy to get back to pre-pandemic levels in the second and third quarter of next year. And if that's the case, then the economy should come roaring back when a rising tide will lift all boats. And I think retail is part of that.
Bob, are you concerned about retail going into 2021?
I'm a little bit concerned about it, but I do think that there are some pockets of opportunity here with retail. And again, I do think that the anti-Amazon trade, which hasn't been alive until this past summer, could certainly be out there right now. And we're not talking about some of the, sadly, unfortunately, what Kenny mentioned is true, that some of these small businesses have died or are going to be dying. And it was not their fault. I have friends of mine who own retail businesses, and their customers are going out of business. They're going to be gone permanently. So it's going to be a tough sledding for that. But I do think that, Catherine, I do think that retail stocks can continue the momentum into 2021 and beyond. Much like Kenny said, that if their online strategy is solid and strong and they deliver on the delivery side, then yeah, definitely, I think these stocks can perform and do well. Don't necessarily need a brick and mortar store to be profitable.
And Jeff, what advice are you giving your members about retail stocks at this point?
Sure. So we own a couple of retailers in the portfolio. Currently, one that we've had for quite a few months now is Nike. And we think Nike, we think that they've had a strong 2020, but we think 2020, especially this holiday season into 2020, could be a very good one for them because they are just way ahead in front of all their competition in terms of their digital strategy. With the new CEO, new management team, they've come in, they really have accelerated that approach, and the economics on digital is far more profitable than it is compared to wholesale for them. So we think the more and more focus that the consumer gets looking for digital channels to shop, it's just only going to really accelerate Nike's profitability. But at the same time, we've been holding on to Amazon for a long time. I do agree that the stock is due for a bit of a pause, but it's a multifaceted story that I think that it can continue to work higher. And same with Walmart Plus, with Walmart, which has the Walmart Plus, which we think we're really bullish on that subscription program. We think that with more people joining the Walmart Plus as Walmart extends the benefits of this newest program, we think that it's going to create a consistent recurring revenue stream. It's a subscription service. So, and we think that could be a catalyst to a higher valuation. In general, we still like retail. We're really sticking with the highest quality names. We haven't really been tempted to go into some of the ones that were, I guess, deemed not essential during the lockdown. But look, if we can get another stimulus deal too, I think that would be also very beneficial for the group as well.
So I want to get to your predictions, guys, because we do have a vaccine coming down the pipeline. All right, Kenny, give me your prediction for 2021. Are there any sectors or stocks that you expect to outperform?
Listen, I think the market's going to do well in 2021. Might have a tough first couple of months, but in the end, I think it'll do well. So therefore, I think broadly the market will do well. But if you want me to pick one or two sectors, I like energy. I think energy is going to come roaring back. I think once the world reopens again, demand is going to surge, and I think that's underappreciated. So in that space, I like Exxon and Halliburton. I tend to be a little bit boring and conservative, but those are the names I like. In banking, you said it, Bob said it, and I already said it. I love JP Morgan and Bank of America, and I'm sticking with those two names.
All right, Bob, what about you?
Well, we did one of these reports about a month and a half ago with Chris, Versace, and Jeff. And as you recall, I mentioned one of the areas that I thought was going to do well was airlines. So I'm gonna take the other side of that hospitality and leisure play. I'm going to say the hotels, and I think the hotels are going to do well. I think I'm looking at names like Hilton, Marriott, Hyatt was one of my favorite names in the space. and even casino names, which I'm teasing you again for my stock, one of my stocks of the year, Las Vegas Sands and Wynn. Not going to tell you which one it is, but Las Vegas Sands and Wynn, they get that China effect as well too with their casinos in Macau. And I think the numbers in Macau have been as bad, if not worse, than I've ever seen, as they've ever seen. I think 9 out of the last 12 months, they had 90% drop in revenue, dollar revenue. It's unbelievable. I mean, really nobody has been coming into the casino. So the bar is really, really low. I mean, it's not just low, it's on the ground. So, I mean, all these casinos really have to do is just step over the bar every single month, and they're probably going to nail, double digit returns if they get some people back after this COVID hopefully goes away in the spring. So the leisure stocks, Catherine, I think are going to do well. I know they've come back quite a bit, and I do think that with a low interest rate environment, with plenty of money flowing, and hopefully jobs returning in 2021, at an even stronger base than we had the past couple of months, I think this is an area that's going to do well.
All right, and Jeff, wrap us up. What are your predictions?
Yeah, I'm actually going to go back to that same conversation Bob just mentioned, and one name that we highlighted then was Boeing. And I think Boeing and stocks tied to aerospace, I think they can continue to work higher. I think most specifically with Boeing, I think the trajectory of their free cash flow, especially in the outer years, is still underappreciated now that we have the vaccine, which is much more effective than I think that what anyone initially anticipated. And I know that the stock has had it's been on quite the run recently, and I know there might be some concerns about them possibly issuing equity to help clean up the balance sheet, but I would actually view that as a bullish move, because the quicker they get debt, the quicker they can reduce the debt, the sooner that we could see a return of the dividend and eventually share repurchases. And I think that's something that would open up the stock back again to a much larger investor class. So I'm going to go with Boeing and stock specifically tied to aerospace as one to look for.
All right, and I want to thank Kenny Polcari, Managing Partner at Case Capital Advisors, Jeff Marks, Senior Portfolio Analyst with Jim Cramer's Action Alerts Plus portfolio, and Bob Lang, Real Money Contributors, for joining us today. I'm Katherine Ross, and of course, stick with The Street for all of the latest on the markets.